I want to tell you about a stock that I am buying every single month and have been for the past 2 years. A stock that represents one of my highest conviction ideas in 3 decades of investing. A stock that I believe will triple over the next 5 years and possibly 10 times over the next decade. A stock that the market is massively undervaluing despite it being one of the best businesses ever created. That stock is Alphabet, the parent company of Google. And I am not just holding it. I am actively accumulating shares every chance I get. Let me tell you why. I have been a professional investor since the early 1990s. I have analyzed thousands of companies. I have invested in dozens of businesses across every sector imaginable. I have made billions on some investments and lost hundreds of millions on others. Over those 3 decades, I have developed a clear framework for what makes a truly exceptional investment. A business with dominant competitive positions that are strengthening, not weakening, multiple revenue streams that are growing at double-digit rates, management that allocates capital intelligently, a valuation that is reasonable, or better yet, cheap relative to the cash flows the business will generate over the next decade. And most importantly, a long runway for continued growth that most investors are not fully appreciating. Alphabet checks every single one of these boxes, and yet the stock trades at a significant discount to other big tech companies and at a massive discount to its intrinsic value. This disconnect between price and value is exactly what I look for as an investor. It is what allowed me to buy Chipotle at $300 when everyone thought it was dead after the E. coli crisis and sell it at $700. It is what allowed me to buy Canadian Pacific Railroad when everyone thought the business was broken and triple my money after installing new management. And it is what makes Alphabet such a compelling opportunity today. The market is mispricing this business, and I am taking advantage of that mispricing by buying as many shares as I can. Let me start by explaining what Alphabet actually is, because I think most people do not fully understand the portfolio of businesses they own when they buy this stock. Yes, Google Search is the crown jewel, but there is so much more. YouTube is the second largest search engine in the world and the dominant video platform globally. Google Cloud is the third largest cloud computing provider and growing faster than Amazon Web Services and Microsoft Azure. Android is the operating system on over 3 billion devices globally. Google Maps is the default mapping application for most of the world. Gmail has nearly 2 billion users. Google Play is one of the 2 dominant app stores. Chrome is the most popular web browser with over 3 billion users. The list goes on and on. This is not a one-trick pony. This is a portfolio of dominant franchises across multiple massive markets. Now let me talk about the financials, because this is where the opportunity becomes clear. Alphabet generates over $300 billion in annual revenue. That revenue is growing at 13 to 15% per year, which is extraordinary for a company of this size. Net income is over $90 billion annually and growing at 18 to 20% per year. Free cash flow is over $80 billion per year. Think about that for a moment. $80 billion in free cash flow annually. That is more than the entire market capitalization of most companies in the S&P 500. And they are generating that much cash every single year while still growing double digits. What is the stock trading at? Approximately 22 to 23 times earnings for a company growing earnings at 18 to 20%. Let me compare that to the other big tech companies. Microsoft trades at 33 times earnings for comparable growth. Amazon trades at 35 times earnings for slower growth. Meta trades at 26 times earnings. Apple trades at 29 times earnings for much slower growth in the low single digits. Alphabet trades at a 30 to 40% discount to peers, despite having comparable or better growth and vastly superior cash flow generation. This makes no sense. The market is giving you the opportunity to buy one of the best businesses in the world at a meaningful discount. I am not going to pass that up. Let me go deeper into why I believe Alphabet is mispriced by walking through each major business segment and explaining why the growth and profitability are sustainable or even accelerating. We will start with Google Search because this is the foundation of everything. Google Search generates approximately $175 to $185 billion in annual revenue. Let that sink in. $185 billion from a single product. That is larger than the total revenue of Nike, Starbucks, and McDonald's combined from one product. And it generates operating margins of 50 to 60%. That means Google Search throws off over $100 billion in operating profit every single year. The business model is brilliant in its simplicity. Google provides search for free to users. Billions of people around the world use Google multiple times per day to find information, research products, get directions, check the weather, everything. In exchange for this free service, Google shows advertisements. Advertisers pay Google to display their ads to people who are searching for relevant keywords. The targeting is incredibly precise. If I sell running shoes and someone searches for running shoes, I can show them my ad at the exact moment they are ready to buy. The return on investment for advertisers is extraordinary, which is why they keep paying more every year. Now, here is what people miss about Google search. The moat is not just the technology. Yes, Google has the best search algorithm. Yes, they have more data than anyone else, which makes their results better. But the real moat is habit and ecosystem lock-in. Billions of people have been using Google for over 20 years. It is a verb. People say Google it, not search for it. This habit is incredibly difficult to break. Even if a competitor built a better search engine, which is extremely difficult given Google's data advantage, people would still use Google out of habit. Additionally, Google is the default search engine on almost every device. They pay Apple and Samsung and other device makers billions of dollars per year to be the default. Once you are the default, inertia keeps you there. Users do not change their default search engine. They just use whatever comes pre-installed. This combination of superior technology, massive data advantages, habit, and default status creates a nearly impregnable moat. The evidence is in the numbers. Google has maintained over 90% global market share in search for over 15 years. Bing has been trying to compete for decades, and they are still under 10% share. DuckDuckGo, Brave, all the privacy-focused alternatives combined are a rounding error. Google's dominance is absolute and shows no signs of weakening. But what about AI? Everyone is talking about ChatGPT and how it will replace Google search. This is the fear that has kept Alphabet's valuation depressed. Investors worry that conversational AI will disrupt search and destroy Google's cash cow. I think this fear is completely overblown and represents the exact reason why the stock is so cheap. Let me explain why ChatGPT is not going to replace Google search. Search is fundamentally about commercial intent. When someone searches for running shoes, they want to see options, compare prices, read reviews, and buy. This is a commercial transaction. Advertisers pay Google to reach these users because they have buying intent. ChatGPT serves a different use case. It is good for answering questions, explaining concepts, generating content, but it does not have commercial intent. If I ask ChatGPT to explain quantum physics, there is no advertising opportunity. I am not trying to buy anything. The queries that ChatGPT handles well are informational queries that generate minimal revenue for Google anyway. The money is in commercial queries, and those are not going away. Furthermore, Google is integrating AI into search in ways that make it more powerful, not less. They have launched Search Generative Experience, which uses AI to provide better answers, shopping comparisons, visual results. This makes Google search more useful, which increases usage, which increases ad impressions, which increases revenue. AI is a tailwind for Google, not a headwind. The market has this completely backwards. Investors are worried about AI disrupting search, when in reality, AI is making search more valuable. This is why I keep buying. The fear is creating a mispricing. Now let me talk about YouTube, because this is the most undervalued asset in Alphabet's portfolio. YouTube generates over $35 billion in annual advertising revenue. That is larger than the entire revenue of Netflix, and it is growing at 10 to 15% per year. YouTube has over 2 billion monthly active users. That is more than any other social media platform except Facebook. People watch over 1 billion hours of video on YouTube every single day. 1 billion hours every day. That is 114,000 years of content consumed daily. The engagement is extraordinary. The average user spends over 30 minutes per day on YouTube. That is more time than they spend on Netflix, TikTok, Instagram, or any other video platform. What makes YouTube so valuable is that it is the only video platform that combines long-form content, short-form content, live streaming, music, education, entertainment, everything in one place. Netflix only does long-form scripted content. TikTok only does short-form. Twitch only does live streaming gaming. YouTube does it all. And they do it better than anyone else. Creators choose YouTube because that is where the audience is and where they can make the most money. Over 60 million creators are on YouTube. YouTube pays out over $30 billion annually to creators. This incentivizes the best creators to prioritize YouTube, which brings more viewers, which attracts more advertisers, which generates more revenue. It is a flywheel. Now here is what is crazy. The market values YouTube at essentially zero. Let me show you the math. Alphabet's total market cap is around $1.9 trillion. Google search alone, at 20 times operating earnings, is worth over $2 trillion. So the market is saying YouTube plus Google Cloud plus Android plus Maps plus everything else is worth negative 100 billion. That is absurd. YouTube by itself should be worth 400 to 600 billion dollars. Here is why. Netflix has a market cap of $250 billion. They generate 35 billion in revenue and about 6 billion in operating income. YouTube generates 35 billion in revenue and approximately 12 to 15 billion in operating income because advertising has much higher margins than subscription streaming. YouTube has no content costs. Creators make the content and YouTube takes a revenue share. Netflix spends over 20 billion per year on content. If Netflix is worth 250 billion with 6 billion in operating income, YouTube should be worth at least 400 billion with 12 to 15 billion in operating income. And arguably YouTube is worth more than Netflix because it has better unit economics, no customer acquisition costs since the service is free, no churn problem, and a much larger addressable market with both advertising and subscriptions. But the market is valuing YouTube at zero as part of Alphabet. This is a $400 billion asset that you are getting for free when you buy Alphabet stock. This is the definition of mispricing. This is why I keep buying. Let me move to Google Cloud because this is where the growth story is even more compelling. Google Cloud generates about $40 billion in annual revenue, and it is growing at 28 to 30% year over year. For context, Amazon Web Services grows at 12 to 15%, and Microsoft Azure grows at 25 to 28%. Google Cloud is growing as faster than Azure and much faster than AWS. And they are taking market share. Google Cloud now has about 11% of the global cloud market, up from 8% just 2 years ago. They are winning large enterprise customers, banks, retailers, healthcare companies, all choosing Google Cloud for their infrastructure. For years, Google Cloud was losing billions of dollars as they built out infrastructure and sales teams. Investors hated this. They wanted Google to shut down cloud or spin it off. But I understood what they were doing. They were investing for the long term. Building the infrastructure required to compete with AWS and Azure requires tens of billions in capital expenditures. You have to build data centers, buy servers, hire engineers. This is front-loaded spending that depresses profitability in the early years. But once you have the infrastructure, the incremental margins on additional revenue are 70 to 80%. This is the same playbook AWS used. Lose money early, invest heavily, then print cash once you reach scale. Google Cloud reached the inflection point. Last quarter, they reported over $1 billion in operating profit. $1 billion per quarter, $4 billion annually. This is up from losing $3 billion per year just 18 months ago. That is a $7 billion swing in profitability in less than 2 years. And this is just the beginning. As revenue scales from 40 billion to 80 billion over the next 4 to 5 years, which is achievable given current growth rates, operating margins will expand from 10% to 30% because of operating leverage. That would be 24 billion in annual operating profit from Google Cloud alone. At a 25 times multiple, cloud would be worth $600 billion. Today, the market is probably valuing it at 100 to 150 billion. Another massive hidden value. Why is Google Cloud winning? 3 reasons. First, they have the best AI and machine learning capabilities. Google invented TensorFlow, Kubernetes, BERT, the transformer architecture that powers all modern AI. Every company wants AI capabilities. Google Cloud offers the best tools and infrastructure for building AI applications. Second, they have the best data analytics platform. BigQuery, Looker, their data warehousing and business intelligence tools are superior to what AWS and Azure offer. Companies are generating more data than ever, and they need better tools to analyze it. Google provides those tools. Third, they are winning on price and service. Google is pricing aggressively to take share, and they are investing heavily in customer support and professional services. Enterprise customers are responding. Now let me talk about capital allocation, because this is another reason I love this stock. Alphabet generates $80 billion in free cash flow annually. What are they doing with that cash? 2 things. Buybacks and reinvestment. They are buying back approximately $60 to $70 billion of stock per year. That is retiring about 3% of shares outstanding annually. Even if the business did not grow at all, earnings per share would grow 3% per year just from buybacks. But the business is growing at 15%. So you get 15% organic growth plus 3% from buybacks equals 18% earnings per share growth. Compound that over 5 years, and earnings per share nearly doubles. Compounded over 10 years, and earnings per share is up over 5 times. The math is simple but powerful. If Alphabet earns $90 billion this year and grows earnings per share at 18% for 5 years, they will earn $210 billion in year 5. At a 25 times multiple, which is still below where Microsoft and Amazon trade, the stock is worth $5.2 trillion. That is up 173% from today's $1.9 trillion market cap, and that assumes the multiple stays at 25 times. If the market re-rates Alphabet to 30 times because they recognize the quality and growth, the stock is worth $6.3 trillion, up over 230%. This is why I keep buying. The math is compelling. The remaining $20 billion per year in free cash flow after buybacks goes to reinvestment. They are spending $10 to $15 billion per year on capital expenditures for data centers, networking equipment, AI infrastructure. They are spending billions on R&D for new products like Waymo, Verily, their life sciences division, moonshot projects. Some of these will fail, but some will succeed and create enormous value. This is option value that the market is not pricing in at all. Even if only 1 or 2 moonshots work, they could be worth tens or hundreds of billions. Let me address the risks, because I do not want to sound like a cheerleader. There are legitimate concerns about Alphabet. Regulatory risk is real. The Department of Justice has filed an antitrust case against Google for monopolizing search. The EU has fined Google billions for antitrust violations. There is talk of breaking up Google, forcing them to divest YouTube or Chrome or Android. These are real risks, but I think they are manageable and already priced into the stock at current valuations. First, antitrust cases take years or decades to resolve. The Microsoft antitrust case in the late 1990s took over 10 years, and ultimately Microsoft was not broken up. They agreed to some behavioral remedies and moved on. The stock went on to increase tenfold after the case was resolved. Second, breaking up Google does not make economic or political sense. Consumers love Google products. They are free and they work well. Politicians are not going to force changes that make consumers worse off. The most likely outcome is some behavioral remedies. Maybe Google has to offer choice screens for default search engines. Maybe they have to allow more competition in the App Store. These changes might reduce revenue by 5 to 10% in a worst-case scenario, but they would not destroy the business. And frankly, the regulatory overhang is one reason the stock is cheap. If and when the regulatory issues are resolved without major structural changes, the stock will re-rate higher. So I am actually happy to buy while this uncertainty exists. Another risk is competition from AI. I addressed this earlier, but let me go deeper. The fear is that ChatGPT and other AI assistants will replace search. People will ask AI questions instead of Googling. This will destroy Google's ad revenue. I think this scenario is wrong for several reasons. First, as I explained, AI handles different queries than search. Informational queries versus commercial queries. Second, Google is integrating AI into their products faster and better than anyone. They have Gemini, which is comparable to or better than GPT-4. They have more data than any other company, which makes their AI better. Third, even if some search volume shifts to AI assistants, Google will monetize those interactions through ads in AI responses or subscriptions to premium AI features. They are not going to sit idle while AI disrupts their business. They will adapt and monetize. A third risk is saturation. Can Alphabet keep growing at double-digit rates when they are already so large? Search is mature in developed markets. YouTube is massive. How much bigger can they get? This is a fair question. My answer is that international growth and new products provide runways for another decade of strong growth. Only about 50% of the world's population is online. As the remaining 50% comes online over the next 10 to 20 years, primarily in India, Southeast Asia, Africa, Latin America, they will use Google products. These new users will drive search growth, YouTube growth, Android growth. Additionally, Google is expanding into new products. Google Cloud is still early with only 11% market share. Waymo autonomous vehicles could be a massive business if it works. AI products and services are just beginning. There is no shortage of growth opportunities. Now, let me compare Alphabet to the other big tech stocks, because this helps illustrate why I think Alphabet is the best value in the sector. Microsoft at 33 times earnings is pricing in continued AI leadership in Office 365 and Azure growth. I own Microsoft and I like the company. But at 33 times, you are paying a premium. If growth slows or AI competition intensifies, the stock could easily derate to 25 times, which would be a 24% decline. Amazon at 35 times earnings is even more expensive. You are paying up for AWS and e-commerce growth. Again, great company, but expensive. Meta at 26 times earnings is cheaper than Microsoft and Amazon, but still more expensive than Alphabet. And Meta faces greater regulatory risk and uncertainty around metaverse spending. Apple at 29 times earnings is expensive for a company growing revenue in the low single digits. The services business is growing, but hardware is mature. I would much rather own Alphabet growing at 15% for 23 times than Apple growing at 3% for 29 times. The math is clear. Alphabet offers the best combination of growth, profitability, and valuation in big tech. You are getting similar or better growth than Microsoft and Amazon at a 30 to 40% discount. You are getting a portfolio of dominant franchises with multiple growth drivers, and you are getting capital allocation that returns cash to shareholders while investing in the future. This is why Alphabet is my largest position and why I keep adding. Let me share how I think about position sizing, because this is important. Alphabet is currently about 15% of my portfolio. That is a large position. Some would say too concentrated. But I have very high conviction. I have studied this business for years. I have met with management multiple times. I have analyzed the competitive dynamics in search, video, and cloud. I understand the financials inside and out. I am as confident in Alphabet as I have been in any investment in my career. When you have that level of conviction and the risk-reward is as attractive as it is here, you should size the position accordingly. I am not going to own 2% of my portfolio in Alphabet when I think it can triple. That does not move the needle. I want this to be a meaningful position so that when it works, it drives portfolio performance. Of course, concentration has risks. If I am wrong about Alphabet, a 15% position can hurt, but I have built-in margin of safety through valuation. Even if growth slows to 10% instead of 15%, even if margins compress slightly, even if regulatory issues reduce revenue by 5 to 10%, the stock is still worth significantly more than today's price. I would need to be very wrong about multiple assumptions for this investment to result in permanent capital loss. That is the margin of safety I look for. As long as I am reasonably right about the business trajectory, I will make good money on this investment. Let me talk about my buying strategy, because this is also important. I am not trying to time the perfect entry. I am not waiting for the stock to drop to some specific price before buying. I am buying consistently over time, regardless of short-term price movements. Some months I buy at $140 per share. Some months I buy at $160. It does not matter. Over 5 to 10 years, whether I bought at $140 or $160 will be irrelevant if the stock goes to $300 or $400. Dollar cost averaging removes the pressure of trying to time entry perfectly. It ensures I am accumulating shares consistently, and psychologically, it makes it easier to keep buying even when the stock is up or down in the short term. I also buy more aggressively when there are temporary pullbacks. If the stock drops 10 to 15% on some piece of news or broader market weakness, I will buy extra shares. This happened several times over the past 2 years. There was a sell-off in late 2022 when investors worried about digital advertising weakness. The stock dropped to around $90 per share. I backed up the truck and bought as much as I could. That turned out to be a great entry point. The stock is now at $160, up over 75% from that low. But even if it was not up, I would have been happy with those purchases because the long-term value is so much higher. Now let me address a question people always ask. If Alphabet is so cheap, why has not the market recognized it? Why has the stock underperformed other big tech names? There are a few reasons. First, the regulatory overhang creates uncertainty. Investors do not like uncertainty. They would rather pay up for a business with no regulatory issues than buy a cheap stock with antitrust risk. This is short-term thinking, but it drives behavior. Second, the AI disruption narrative has scared people. Even though I think the fear is misplaced, many investors believe ChatGPT will disrupt search. This keeps them on the sidelines. Third, Alphabet does not have a visionary celebrity CEO like Apple has, or had with Steve Jobs, or Tesla has with Elon Musk. Sundar Pichai is a great operator, but he is not a showman. He does not generate headlines or excitement. This makes Alphabet less sexy to retail investors and the media. Fourth, the company is complex. Most people do not understand that YouTube should be valued at 400 to 600 billion, or that cloud is inflecting to massive profitability. They just see Google stock and think of search. They do not appreciate the portfolio of assets. This complexity leads to undervaluation. But for sophisticated investors who are willing to do the work to understand the business, this complexity creates opportunity. I am happy to buy from investors who do not understand what they own. Their loss is my gain. Eventually, the market will figure it out. YouTube will be properly valued, cloud profitability will be recognized, regulatory issues will be resolved, AI fears will subside, and the stock will re-rate to where it should be trading. When that happens, I will have made a lot of money. But even if it takes 5 years for the market to wake up, I am fine with that. I am earning solid returns from business growth and buybacks while I wait. Let me paint a picture of what Alphabet looks like in 5 years to make this concrete. Search revenue grows from $185 billion to $240 billion as international markets mature and AI integration increases engagement. That is 5% annual growth, which is conservative. YouTube revenue grows from $35 billion to $60 billion as they increase monetization of shorts, expand subscriptions, and grow internationally. That is 11% annual growth. Cloud revenue grows from $40 billion to $100 billion as enterprise adoption accelerates. That is 20% annual growth. Other businesses, including Play, Network, and Hardware, grow modestly. Total revenue goes from $300 billion to $480 billion. Operating margins expand from 30% to 35% as cloud scales and operating leverage kicks in. Operating income goes from $90 billion to $168 billion. After tax, net income is approximately $134 billion, up from $90 billion today. Shares outstanding decline from 14 billion shares to 12.5 billion shares due to buybacks. Earnings per share is $10.70, up from $6.40 today. At a 25 times multiple, the stock is worth $267 per share. That is up from today's price of around $160. A 67% return plus dividends over 5 years, approximately 11% annualized, and that is using conservative assumptions. If cloud grows faster, if margins expand more, if the multiple re-rates to 30 times, the stock could be worth $300 to $350. 88 to 119% return over 5 years, 13 to 17% annualized. These returns are very attractive for a company of this quality and size. You are not going to find many $2 trillion companies that can compound at double digits for the next decade. Alphabet is one of the few. This is why I keep buying and why I will continue buying for years to come. Now let me address what would make me sell. I am not a buy and hold forever investor on principle. I will sell if the thesis breaks. What would break the thesis? A few scenarios. If regulatory actions forced a breakup that significantly impaired the business value, I might sell. But even then, the sum of the parts might be worth more than the whole. If search market share started declining materially and permanently, say dropping from 90% to 70%, that would be concerning. That would indicate a real competitive threat. If cloud growth slowed to single digits and margins did not expand, that would suggest they are not going to win in enterprise. If management made a massive capital allocation mistake, like an overpriced acquisition that destroyed value, I would reconsider. But absent one of those scenarios, I plan to hold this position for many years. I am thinking in terms of decades, not quarters. This is a compounding machine. As long as the business keeps growing and generating cash, I am happy to own it. I do not need to sell to lock in gains. The gains will compound over time. This is how you build generational wealth. You find exceptional businesses at reasonable valuations and you hold them through volatility and let compounding work. Alphabet fits this profile perfectly. Let me close with a final thought on why this opportunity exists. Markets are generally efficient, but they are not perfectly efficient, especially for complex businesses. Alphabet is complex. It has multiple business units with different growth rates and profitability profiles. It faces regulatory uncertainty. It competes in markets that are evolving rapidly with AI and cloud. This complexity creates noise, and noise creates opportunity for investors who are willing to do the work. I have done the work. I understand the business. I understand the competitive dynamics. I understand the financials. I understand the risks. And after all that analysis, I am highly confident that Alphabet is significantly undervalued and will generate substantial returns over the next 5 to 10 years. That is why I keep buying. That is why Alphabet is one of my largest positions, and that is why I recommend anyone who is looking for a high-quality compounding machine at a reasonable valuation to take a serious look at this stock. You do not find opportunities like this very often. A $2 trillion company growing at double digits with fortress balance sheet and multiple growth drivers trading at a discount to peers. When you find an opportunity like this, you need to act, you need to buy, and you need to hold. That is exactly what I am doing with Alphabet. I am buying and I am not stopping. Let me go even deeper into specific aspects of the business that I find most compelling, because these details matter when you are making a multi-billion-dollar investment decision. Starting with the advertising business model itself. People sometimes dismiss Google as just an ad company, as if that is a limitation. But the digital advertising business model is one of the most beautiful business models ever created. Let me explain why. Traditional advertising like television or print is inefficient. An advertiser pays to show their ad to everyone watching a TV show or reading a magazine, even though most of those people are not interested in the product. The targeting is crude. You can target by demographics or by content category, but that is about it. And you have no idea if the ad worked. Did someone see your TV commercial and then buy your product? Maybe. You cannot track it. Digital advertising solved all of these problems. With Google search ads, an advertiser only shows ads to people who are actively searching for related products. If I sell running shoes, I only pay when someone searches for running shoes and clicks my ad. The targeting is perfect. I am reaching exactly the people who want my product at exactly the moment they want it. And I can track everything. I know how many people clicked my ad. I know how many bought my product. I can calculate my exact return on ad spend. If I spend $1 on ads and generate $5 in sales, that is a 5-to-1 return. That is measurable, scalable, profitable advertising. No traditional advertising medium can match that efficiency. This is why digital advertising has been taking share from traditional advertising for 2 decades and will continue taking share. Total global advertising spending is about $800 billion per year. Digital is about 60% of that and growing. Television and print are declining. Within digital, search advertising is about $180 billion and growing at high single to low double digits. That is Google's core market. They have about 90% share of that $180 billion market. Display advertising, which includes social media, video, banner ads, is about $300 billion and growing faster. YouTube captures a piece of that market with video ads. The total addressable market for Google's advertising business is $400 to $500 billion, and it is growing at 8 to 10% per year as digital takes share from traditional media. Google only has about $180 billion from search plus $35 billion from YouTube equals $215 billion in total ad revenue. That is about 43% of their total addressable market. They have room to grow for decades just by maintaining share as the market grows and by taking a bit more share within digital. This is not a mature, saturated market. This is a growth market where the leader is compounding at double digits off a massive base. Now, let me talk about a specific competitive advantage that does not get enough attention. Network effects in advertising. Google has network effects on both the supply side and the demand side. On the supply side, more users searching on Google means more ad impressions, which means more advertisers want to buy ads, which means more revenue, which means Google can invest more in improving search quality, which attracts more users. That is the flywheel. On the demand side, more advertisers bidding on keywords means higher prices for Google. If only 10 companies want to advertise on a keyword, Google might charge $2 per click. If 100 companies want that same keyword, Google can charge $10 per click through auction dynamics. More demand equals higher prices equals more revenue for the same number of clicks. This is operating leverage from network effects. As Google's advertising platform gets bigger, it gets more valuable per user, not less valuable. This is the opposite of most businesses where scale leads to diminishing returns. Google has increasing returns to scale. Let me give you a concrete example of how this plays out. YouTube Shorts is Instagram Reels and TikTok competitor. Short-form vertical video. YouTube launched Shorts about 2 years ago, and it already has over 2 billion monthly users watching over 30 billion views per day. That is extraordinary growth. But here is what matters more. YouTube is now monetizing Shorts through ads. They are showing ads between Shorts videos. Early data suggests the monetization per view on Shorts is lower than on long-form YouTube videos, but it is ramping quickly. If YouTube can monetize Shorts at even 50% of the rate they monetize long-form, that is tens of billions in incremental high-margin revenue over the next 3 to 5 years from a product that did not exist 2 years ago. This is the innovation engine at work. Google is not just defending their existing businesses, they are launching new products that become massive revenue generators. Shorts, Google Cloud, AI products. The pipeline is full. Now let me talk about something that keeps me up at night in a good way. The option value in Alphabet's portfolio. When you buy Alphabet stock, you are getting search, YouTube, cloud, Android, all the core businesses I have discussed. but you are also getting a portfolio of moonshot bets that could each be worth tens or hundreds of billions if they work. Waymo is the autonomous vehicle division. They have been working on self-driving cars for over 15 years. They have driven tens of millions of miles in real-world conditions. They operate a commercial ride-hailing service in Phoenix and San Francisco. Waymo is arguably the leader in autonomous driving technology, ahead of Tesla, Cruise, everyone else. If autonomous vehicles work and become mainstream, the ride-hailing market alone is worth hundreds of billions. Waymo could be worth $100 to $200 billion as a standalone business. Verily is the life sciences division. They are working on health monitoring devices, disease detection, drug discovery. The healthcare market is enormous. If Verily develops a breakthrough diagnostic tool or therapy, it could be worth tens of billions. Google DeepMind is the AI research lab. They developed AlphaGo, which beat the world champion at Go. They developed AlphaFold, which solved the protein folding problem and won a Nobel Prize. The applications of this AI research are vast. Drug discovery, materials science, optimization problems. DeepMind's technology could be licensed or spun out and be worth 50 to 100 billion. There are other bets. Fiber for high-speed internet, Loon for internet balloons. Some of these will fail. Loon already shut down. But the few that work could create hundreds of billions in value. And here is the key point. The market is valuing all of these moonshots at zero. You are getting them for free when you buy Alphabet. If just one or two hit, that is massive upside on top of the base business. This is pure option value. It is like buying a company for the present value of their current cash flows and getting free lottery tickets that could each be worth billions. I love that asymmetry. Now let me address a specific concern that some investors have raised. They worry that Google is losing talent to startups and other big tech companies. The best engineers want to work on cutting-edge AI at OpenAI or Anthropic, not at a big bureaucratic company like Google. This concern has some merit, but I think it is overstated. Yes, Google has lost some talent. Some researchers left to start AI companies. But Google still employs tens of thousands of world-class engineers. They still publish more AI research papers than anyone else. They still attract top talent from universities, and they have advantages that startups cannot match. Resources. Google can spend tens of billions on AI research and infrastructure. Startups raise a few hundred million and have to be very selective. Data. Google has more data than any other company. Search data, YouTube data, Gmail data, Maps data. This data makes their AI better. Distribution. Google can integrate AI into products with billions of users overnight. OpenAI has to convince people to download ChatGPT. Google just updates Google Search, and boom, everyone using Search has AI features. These advantages matter. Yes, startups are more nimble and can innovate faster in some areas, but Google has staying power and the ability to scale innovations globally. I am not worried about a talent exodus destroying Google's competitive position. They will be fine. Let me talk about international growth because this is a massive opportunity that is underappreciated. About 47% of Google's revenue comes from the United States. The remaining 53% comes from international markets. But the US is only about 4% of the world's population. There are 7.5 billion people on Earth and only about 60% are online. That means 3 billion people are still not connected to the internet. Over the next 10 to 20 years, most of those 3 billion will come online. They will get smartphones, they will get internet access, and they will use Google products. This is billions of new users for search, YouTube, Maps, all of Google's services. These users will drive revenue growth for decades. The economics in international markets are also improving. Advertising rates in emerging markets have historically been much lower than in the US because GDP per capita is lower. But as these economies develop and incomes rise, advertising rates will increase. An ad click in India might be worth 50 cents today versus $5 in the US. But as India's economy grows and consumers have more purchasing power, that 50-cent click could become a $2 click. Same number of clicks, 4 times the revenue. This is happening across Southeast Asia, Latin America, Africa. Rising incomes are increasing the value of international users. Google is perfectly positioned to benefit from this global growth. They are already the dominant search engine and video platform in almost every market. As those markets mature, Google's revenue and profit will grow. Now let me talk about a specific risk that I think about a lot. What if Apple decides to build their own search engine? Apple has billions of users on iPhones and iPads and Macs. They currently use Google as the default search engine, and Google pays Apple about $20 billion per year for that privilege. But what if Apple decides to keep that 20 billion by building their own search engine and making it the default on Apple devices? This would be a huge threat to Google. They would lose billions in revenue and potentially lose market share if Apple's search engine is good. I think about this scenario and I conclude the risk is manageable. First, building a search engine from scratch is incredibly difficult. Microsoft has spent billions trying to make Bing competitive, and they are still under 10% market share. Apple would face the same challenges. They do not have Google's data advantage or AI capabilities. Second, Apple's business model is selling hardware and services to their users. Advertising is not their core competency. They have actively positioned themselves as the privacy-focused alternative to Google and Facebook. Building an ad-supported search engine would contradict that positioning. Third, the 20 billion Google pays. Apple is high-margin revenue for Apple. It goes straight to the bottom line. If Apple built their own search engine, they would have to invest billions in development and infrastructure, and they might not generate more than the 20 billion they are already getting from Google. The risk-reward does not make sense for Apple. So while I monitor this risk, I do not think it is likely to materialize. And even if it did, Google would still have Android, Chrome, and organic traffic. They would lose some share, but it would not be fatal. Let me talk about the balance sheet, because this is another underappreciated strength. Alphabet has over $100 billion in cash and short-term investments. They have no debt. This fortress balance sheet gives them enormous flexibility. They can weather any economic downturn. They can make large acquisitions if the right opportunity appears. They can return massive amounts of cash to shareholders through buybacks and dividends. They do not have financial constraints that limit their strategic options. Compare this to other companies. Tesla has taken on debt to fund expansion. Many tech startups burn cash and need to raise capital. Alphabet generates 80 billion in free cash flow and has 100 billion in cash. They are printing money. This financial strength is a competitive advantage. When markets get turbulent, companies with weak balance sheets struggle. Alphabet will be fine. Now let me share my updated price target based on all of this analysis. I think Alphabet is worth at least $300 per share today. That is based on a sum of the parts valuation. Search at 20 times operating earnings is worth 2.2 trillion. YouTube at a 30 times multiple on operating earnings is worth 450 billion. Cloud at a 25 times multiple on current revenue, given the growth trajectory, is worth 150 billion. Other businesses worth 50 billion. That is 2.8 trillion in total, minus about 20 billion in net liabilities for stock compensation and other items equals 2.78 trillion. Divided by 13.7 billion diluted shares equals $203 per share. And that is using conservative multiples. If I use pure multiples, search would be worth more, YouTube would be worth more. The stock could be worth $250 to $300 just based on current earnings power. Looking forward 5 years, I think Alphabet is worth $400 to $500 per share. That is based on the scenario I laid out earlier, where revenue grows to 480 billion, earnings grow to 134 billion, and the stock trades at 25 to 30 times earnings. From today's price of $160, that is 150 to 200% upside, 20 to 25% annualized returns for a $2 trillion company. Those are exceptional returns. This is why I keep buying. This is why Alphabet is a core holding. This is why I will continue accumulating shares for years to come. Let me end with a personal reflection on what this investment means to me. I have made a lot of money in my career. I have had great wins like Canadian Pacific and some tough losses like Valiant. But the investments I am most proud of are the ones where I identified a high-quality business that was misunderstood or undervalued, and I had the conviction to buy a lot and hold through volatility. Alphabet is shaping up to be one of those investments. I started buying about 2 years ago when the stock was around $100 after it had sold off on advertising concerns. I have been adding consistently since then. My average cost is probably around $120 to $130. I now have a position worth billions, and I think it will be worth many more billions in 5 to 10 years. But beyond the money, what matters to me is the intellectual satisfaction of being right about a complex business. Understanding the competitive dynamics better than the market, seeing the value in YouTube and cloud before others, recognizing that regulatory fears are overblown, having the courage to build a concentrated position despite the uncertainty. This is what I love about investing. The challenge of understanding businesses deeply and finding mispricings. Alphabet is a perfect example. The market is giving me the opportunity to buy an exceptional business at a reasonable valuation. I am not going to pass that up. I am going to keep buying until the market wakes up and the stock re-rates to where it should be trading. And when that happens, I will have generated substantial returns for my investors and myself. That is the goal. That is what I have been doing for 3 decades, and that is what I will keep doing with Alphabet. This is a compounder. This is a business I want to own for a very long time. And I am going to keep buying it because the value is there and the opportunity is real. If you are looking for a high-quality investment with strong growth, excellent capital allocation, multiple growth drivers, and attractive valuation, take a serious look at Alphabet. Do the work, understand the business, and if you come to the same conclusion I have, buy it and hold it, you will be glad you did. Let me share one more critical insight about why I believe the market is undervaluing Alphabet so significantly. It comes down to a fundamental misunderstanding of what drives long-term stock returns. Most investors focus on growth rates. They want companies growing revenue at 25 or 30%. They want the next high-flying tech stock that will 10 times in 3 years. This mindset leads them to overpay for speculative growth stories while ignoring exceptional businesses growing at more moderate but sustainable rates. Alphabet grows revenue at 13 to 15%. To some investors, that sounds slow. They would rather own a company growing at 30% even if that company is unprofitable and trading at 10 times revenue. But here's what they miss. Stock returns over long periods are driven by 3 factors: earnings growth, multiple expansion or contraction, and shareholder yield from buybacks and dividends. Let me break down Alphabet on these 3 dimensions. Earnings growth is 15% from organic business growth plus 3% from share buybacks equals 18% per year. Multiple expansion potential is significant because Alphabet trades at 22 times earnings while peers trade at 26 to 33 times. Even a modest re-rating to 25 times, which is still below Microsoft, would be a 14% one-time gain. Shareholder yield from buybacks is 3% annually. Add those up. 18% earnings growth plus 3% shareholder yield equals 21% annual returns if the multiple stays flat. If the multiple expands to 25 times over 5 years, add another 2.6% annually for a total of 23 to 24% annual returns. Compare that to a speculative growth stock trading at 10 times revenue with no earnings. That stock needs to grow revenue at 30% annually just to justify its current valuation. If growth slows to 20%, the stock crashes. If the company never reaches profitability, the stock goes to 0. The risk reward is terrible. You are taking huge risk for uncertain returns. With Alphabet, you are getting 20+% annual returns with far less risk because the business is profitable, growing, and undervalued. This is why I focus on high-quality businesses at reasonable valuations rather than chasing growth at any price. Over decades, this approach wins. Let me also address a philosophical question about investing that relates to my Alphabet position. Some investors believe in extreme diversification. They want to own 100 or 200 different stocks to spread risk. I disagree with this approach, at least for investors who are willing to do deep research. If you own 200 stocks, you cannot possibly know all of them well. You are basically closet indexing while paying active management fees. I would much rather own 10 to 20 stocks that I know intimately and have very high conviction in. Yes, this is more concentrated. Yes, if I am wrong on 1 or 2, it hurts. But if I am right on most of them, the returns are far superior to owning 200 mediocre businesses I do not really understand. Alphabet is a perfect example of where concentration makes sense. I've spent hundreds of hours studying this business. I have met with management. I've analyzed the competitive dynamics. I have modeled the financials under multiple scenarios. I know this business as well as I know any investment I have ever made, and my conviction is extremely high. In that situation, owning just 2 or 3% of my portfolio in Alphabet would be a waste. If I am right and it triples, 2% becomes 6%. That barely moves the needle on overall portfolio returns. But if I own 15% and it triples, that is a massive impact. 15% becomes 45%. That drives portfolio performance. This is why I am comfortable with concentration in my highest conviction ideas. Alphabet is one of those ideas. Now let me share a final thought about the timing of this opportunity. I believe we are in a unique window where Alphabet is significantly mispriced, and that window will close as the market recognizes the value. When will that happen? I do not know exactly. It could be 6 months, 2 years, 5 years, but eventually YouTube will be properly valued, cloud profitability will be recognized, regulatory issues will be resolved, AI fears will subside, and when those catalysts play out, the stock will re-rate quickly. I do not want to be buying after the stock has already gone from $160 to $250. I want to be accumulating now while it is cheap, This is the advantage of being patient and having a long-term mindset. I can buy while others are scared or confused, and I can hold while the value is realized. That is exactly what I am doing with Alphabet. I am building a massive position while the opportunity exists, and I will hold for many years as the business compounds and the market eventually recognizes what I see today. That is the playbook. That is why I keep buying, and that is why I will not stop.